much for joining us today. We are very pleased to work in conjunction with Abrigo to bring you this webinar, Managing Your Balance Sheet During Uncertain Times. I will note that this is session 1. Session 2 is next week. So if you like part 1, come back for part 2. I think you will. We have a couple of great speakers joining us today. Dave Koch and Rob Newberry from Abrigo. I should say I'm Susan Seville. I'm the Director of Sales for Federal Home Loan Bank Topeka. And let me tell you a little bit about Dave and Rob. Dave is Managing Director of Advisory Services with Abrigo, and he's also a lead faculty member at the Graduate School of Banking in Madison. He specializes in executive level advisory services and is actively involved with capital planning, strategy, loan and deposit pricing, evaluating interest rate risk and other ALM concerns of clients. He has had a tenure of 25 years with Farron, which was what Abrigo was formerly. Now it's Abrigo. And he is a featured speaker at regional and national industry events, and he's addressed chief examiners and deputy commissioners from 36 states about interest rate risk management and how new regulations impact small to mid-sized institutions. Rob Newberry has over 20 years of experience in the financial services industry. He spent 15 years at Wells Fargo in various strategic and leadership roles. For the past 5 years, Rob's worked closely with financial institution leaders and regulatory agencies to develop a credit administration suite of tools specifically designed for community banks and credit unions. Rob is a faculty member also of the Graduate School of Banking in Madison. So welcome you all. Thank you for helping us with this webinar. I will let all the attendees know that you can feel free to ask questions using the chat function as the webinar progresses. We will address those at the end in a Q&A session. You can also ask questions during that time of the webinar too. So with that, I will turn it over to Dave and Rob.
Susan, thank you very much, and thank you everybody for being here. It's a pleasure, and I think the last time I saw some of the names in the attendee list would have been out in Topeka for the annual meeting at the golf outing, where it was a little unseasonable and different, and we were talking about a lot of different topics than we're going to talk about today. Times change quickly, and that's one of the reasons why when Susan reached out and said, could we do some work on putting a webinar together, we're excited to do that and bring some thoughts to you all along the way. As Susan mentioned, the Q&A section of the WebEx feature is available to you. Please feel free to jump in there, type your questions in. If possible, we'll take them in line, but probably more likely what will happen is we'll take them towards the end. If for some reason we run out of time at the end, we will certainly answer all those questions. There's a resource page where many of you got a link to get to today's slides. We'll also put any question answer Q&A pieces out there for you to access as well. So feel free to do that. We will be taking some polling slides today just to get your feedback. We are offering CPE credit for this. So in that process, we obviously have to know that you're still there and that you're still listening. So there will be some interactive polling. Susan will be running that for us, or maybe it's Jesse's going to be running that for us from the Federal Home Loan Bank. Please be sure to do that. If you're looking at the presentation on full screen and for some reason you cannot interact with the polling slide, we've had this happen in other platforms, feel free, just dump in your answer into the Q&A section so that we can log that you were a part of the poll. It's really more about making sure we have audit capabilities to give you the CPEs. So lots of resources out there in the setup slide. A little bit of pictures of us, but hey, you're going to get to see us today live with the cameras on. Kind of nice getting used to this whole virtual sessioning. We should have been at Graduate School of Banking right now. We should have been finishing up the middle of the week of week 1 of GSB, but this year obviously the pandemic has changed those plans for the first time, and I think some of you may have been there or had people going there, and it's kind of an odd feeling for the first time in 20-some years not to be on the campus of Madison, although I'm 8 miles away. Feels like a world away in this time. So Let me just let Rob pop in here so you can see his face, hear his voice, and get to know him. Rob, how are you in Topeka? I'm in the Madison area, or not in Topeka, in Des Moines. How are things in
Yeah,
your neck of the
great.
woods?
Hey, Dave, great to be here. Yeah, it's nice and warm here it's actually a little cool here in Des Moines for this time of the year. And yeah, Madison's a great place to be for GSB. I also missed that 2 week experience on the Madison campus. But glad to be here with the folks from Topeka.
Well, we're going to try and take some time today to set up a situation or two for us. And I'm going to ask you all to sort of be willing to play along here because I think we've been pretty consumed over the last 4 or 5 months with an obvious, unexpected, and hugely disruptive um, change. I mean, complete and total curveball that nobody saw coming that's changed our world. But eventually things will return back to something like where we were. And I want to be sure that we don't lose sight of what that looked like because today I've got a lot of you sitting flush with cash. PPP loans went out, people getting extra cash coming in, people aren't spending as much. Balance sheets look very different here as we enter August than they did in August of last year, even September, October, November of last year for most of us. And so we need to remind ourselves of some of the challenges that we had then and now, so we make sure that we think about how what we do today might impact where we might end up again when some of normalcy returns. So we want to take a look a little bit at the overview of what's been facing us as an industry in a more global sense and talk a little bit about today's challenges along the way. Susan mentioned two-part series. And so we're going to go through some material today and we're going to set up session 2. It does build on one another, so would urge you to come back. And if you know somebody that can't make it, we will have the recording available for you. So make sure that we are, in fact, giving you a chance to hear that. So I want to talk about some different concepts. I'm going to introduce this idea of managed sustainability. Seems like a good word to use in today's world, but we need to put some context around that and talk a little bit about what do we do with all this liquidity of the balance sheet today. So let's go ahead and jump in and ask the question. When I say sustainability, what do I mean? I mean, that word, when you hear it in the news today, when you read it in print, when you hear it bandied about, has a very different connotation maybe than what I'm using it as, but it's similar in nature. And that is the definition of sustainability is to be able to be maintained or at a certain rate or level. So whether that be the environment or whether that be our net interest margin, our growth levels, our profitability, our customer levels. I think those are things that we need to think about from a community banking standpoint. It's the avoidance. The second definition is the avoidance of the depletion of natural resources to keep us in balance. And as a community banking industry, I think we have to ask the question, what are our natural resources? If that's a definition that we could borrow, what are the natural resources that we rely upon as a community financial institution? I'd argue, I think that the number one thing that we rely on is spread, right? We lend out the money that we buy at a positive rate, and that generates earnings for us to operate the business, pay our shareholders, build capital, do whatever we do with the money we make. But without spread, it's a pretty hard game, and that's one of the things we're facing right now. And that's been the natural resource for years and years. When I ask this question of the GSB students or just generally, what makes you different from others in your market, I often hear about how the service that you offer is really a differentiator to your customers. And I think we found out a lot about that as this pandemic came through, right? Because service was always an important thing to be able to deliver face to face. Like we could see each other today. Well, you could see me anyways. I can't see you. And that changes the service equation a whole bunch. We became a digitally oriented institution in many facets faster than some of us maybe expected we'd have to be. Now we found ways around it to continue to try and get things done, and we were very nimble in the fact that we had to adapt. But I think as we look forward into the sustainability of future generations, that service expectation with the ability to manage relationships in a different way, it's very real. And I mean, all you have to do is pick up any trade magazine, any press, anything. And we've been talking about how fintech, how digital relationships, how all of this has changed. And I often wonder, Will the Federal Home Loan Bank, will the Graduate School of Banking, will the State Bankers Associations, will the ABA, the ICBA, NCUA, or CUNA, any of these trade groups go back to having the kind of relationships they had before? Will we put a big convention on in Orlando ever again? Or are we going to be a new hybrid model of service and delivery that we weren't thinking we were ever going to do? What's that mean for you? I think we got to think about that and ask, how well have we managed that overall set of resources? I don't know, Rob, are there any other resources from a community banking space that you'd say come to mind for a natural resource that we got to be thinking about?
A couple of those things, Dave, that we've thrown around before are availability in community areas, where big banks don't like to go. They're a resource for a lot of fire stations and things that people don't even think about. And without them, it's hard to sustain those small communities that we all rely on, especially here in the Midwest.
I think about when I used to be part of the Girls Softball Association when my daughter was younger, and we'd hold a big tournament in town, and we would need cash, make change for the concessions that we were running. And community bank was there. If the community bank wasn't there, the next best thing was, in our case, Quick Trip gas station convenient mart. They were there. So you think about, where do people go for what they need, right? We need to be that focal point for a lot of that, and how do we give back to that? I think that's really important. So what's it going to take us then to manage that? What's the cost of managing tomorrow's sustainability? This is the age old, how do you measure a payback? Is it in next year's dollars? Is it in 5-year dollars? Where's the break even cost calculation? I think the thing we have to remember here, and we'll talk about it significantly as we go through the discussions here today and next week, is that every decision has a cost. And sometimes that decision is a cost that we know after the fact. Like, the lack of action today is a cost tomorrow. But I think, when we think back to where we were in 2018, when interest rates sort of peaked after rising by 300 basis points over 2 years, we were still worried about the fact that rates could keep going up. So we shied away from, in a rising rate environment, putting any longer term assets on the books. And I'm not saying that's the only strategy, but wouldn't it be nice to have had along the way, as rates came back down, some longer term assets now, whether it's in the bond portfolio or in the loan portfolio? As rates came down, it'd be nice to have some of those assets yielding us more. So we made that decision. We made it for all the right reasons at the time, whatever those reasons are. But looking back at it now, we can say the cost of that was, in today's dollars, what I didn't earn by staying shorter and now being at lower interest rates. It's not an indictment. It's not a negative. Just, that's always the cost. There's always a cost benefit. For every action, there's an equal and opposite reaction. Laws of physics kind of apply here when we start thinking about profitability management within the sustainability. So we're going to use this idea of sustainability. And my biggest number of sustainability questions are going to relate to that spread piece around the community natural resource of spread, because if we have to rely on other volume plays to be transaction people, then scale is going to become a problem for us. There's people that are going to be bigger to do that. We'll talk about that some more here in just a little bit. But I want y'all to stop for just a second. If you've got the slide deck, you can mark this up. If not, download it, mark it up. We're not going to do this as a polling slide. You'll know it's a polling slide because there'll be a big yellow screen up that's on, and then it'll pop up with a poll in front of you. But this one's blue because it's a thinking slide. I want you to think back to 9 months ago. 9 months ago would have put us right in the height of the end of budgeting season, getting ready to turn on a new year. What were we thinking about as we looked into 2020, 2021, 22, 23? I mean, I can remember talking to people about the inverted yield curve at the time and what was that going to do to the margin. I was worried about the non-interest income generation. What were we going to do to generate non-interest income? Loan to deposit and loan to asset ratios were high. There was pressure on deposit growth. We had people putting out CD rates back in the 2s for short-term CD. There was longer-term fixed rate loan pressure on everybody because everybody was worried rates might go back up. We had non-bank competitors entering the space. We had the pending CECL change, which for many of us is still pending. The regulatory environment was completely and totally a guess on where things were going to go and how it was going to work. And then you could add to that anything that I didn't get to that was on your mind. And I want to ask you, as we sit here today, are any of those things still, or let me ask it this way, what doesn't belong on that list anymore? I guess we could take deposit growth pressure off for a lot of us because we were sitting with a ton of money, but where did it come from? Is it going to stay? In the long run, don't I still need deposit growth? But we've got more non-bank competition coming out, right? You saw where, we've got Google out there signed up, but I think they've got 4 or 5 pilot banks for their checking account now. And that's a big deal. There's a lot of these things that still matter to us, and it threatens our sustainability. So a little bit of a strategic planning discussion is, don't forget about the fact that just because this pandemic hit and has consumed us in today's events, over the long run, this is where we were, and we'd been there for a while. So keep that in mind. So with that in mind, let's go into the Wayback Machine. Anybody remember Sherman and Mr. Peabody and the Wayback Machine from way back when? I'm going to ask you to turn your clocks all the way back here a ways and take a look at some average community bank data. I just picked the banking UBPR peer group 5, 300 million to $1 billion to pull this data. Now, there's some interesting things, and I just cherry picked some of these numbers. I'm not going to spend a lot of time on them, but what I want you to notice is 2006 to 2009, that was right ahead of the bubble bursting, right? It was a pretty robust growth period. We were growing assets on average. We saw pretty good growth of about $90 million, roughly $30 million a year for 3 years from 06 through 09. 2011, by the time we fully unwound the credit losses into the community bank space, we saw a fairly major contraction. Now, some of the upper limit banks got bigger through acquisition, so maybe it's just what was left ended up being a little bit smaller. Could have been a sample size that changed there. But you can see that between 2011 and 15, we didn't grow a lot as an industry. And then by 2019, we started growing again. Again, I think there's probably some acquisition in there that may have taken that growth, the rule of numbers in there. But along the way, you look at the bottom, tangible equity, risk-based capital ratios. Capital was never our concern in this. We survived the pandemic primarily as community banks in that space because we were really well capitalized. But what did we do? We had a very variable growth rate in there. I don't have the data yet, but early indications are if you look at the highest performers through that period, though, one of the things you're going to find is they didn't stop growing. They may have grown more slowly, but they didn't stop growing. So that when 2009 hit them, it wasn't the only thing that was going on. They were still adding good assets while they were dealing with the bad assets. So now that we're recovered and we're going through it this time, what's happening? We're growing. Again, it was forced growth. I don't know if we can stop that growth, but it's certainly growing. And we need to decide how is that going to affect what we do now. Take a look at this. What's the lesson that we should learn from history of curves? The bars on this are July 20th U.S. Constant maturity treasury rates. If you look at that and you go back in time, 2003 and 2005 and 2008, we had low interest rates in those periods too, and we had a positive slope to the yield curve. But as we moved into 2010, we saw long-term interest rates go up, although they were down from 03 levels, they went up from 08 levels, right? And then by 14, long-term interest rates came down, the blue line, light blue line. December of 17, the Fed starts taking action. By 18, short-term rates have moved up, long-term rates didn't move up. In December of 05, we had a very flat yield curve with high rates. In December of 18, we had a very flat yield curve with 2.5% rates. They almost look exactly alike, don't they? So as we sit here and we start thinking about sustainability, and we ask the question, what happens in a rising rate environment? Let me ask you, what rising rate environment are we trying to pick? Is it a rising rate environment where all boats float the same amount? Because when I look at that graph, other than 05, pretty much the most volatility has been on the long end. There's been some long or short end. The long end volatility has been somewhat moving, but over time that short end has moved a whole lot longer than the long end has moved. And I want us to be thinking about that as we design how we get through this current flat yield curve. Coming out of every flat yield curve, we typically see the Fed move, and that short-term rate tends to move faster than long-term rates Long-term rates will recover in the long run. So keep that in mind as we look at that. And let's take a look at what we did from an asset growth perspective. Pretty consistent grower over the years. Year over year, slow and easy, keep it going. Loan to deposit ratios stayed really high. Loan to asset ratios were pretty good. Came down a little bit as we needed some more liquidity, but still maintained a pretty liquid position. So it says, look, I'm willing to take a pretty good stance on my loan position relative to total assets, relative to deposits, and you take your equity in there. I probably had some room. I could have pushed it a little bit harder into loans, but we were getting a lot of pressure to maintain asset-based liquidity, and so we didn't really push it. That loan to deposit ratio is a really tough measure for me to get excited about, and that's been falling over the years as we look at the growth of deposits versus the growth of loans. Over time, loan growth has been a little bit slower than deposit growth on average over 3 years. A little bit different in 15, but those are year over year numbers that you're looking at, not the cumulative between those years. Take a look at net interest margin along the way. Notice that net interest margin, I'm using tax exempt so that we can keep everybody on the same basis here. I was up in the mid low fours early in 2009 and 11. 2015, 2019, I'm down around 390. Non-interest income has been pretty steady. This year's non-interest income should be stellar for most of us because we've had PPP loan non-interest income, and we might have the prevalence of mortgage origination and sale income through a huge refi boom. So I expect that our numbers will look pretty good when we look at non-interest income for 2020. But is that sustainable, right? Is that sustainable levels of earnings? And if not, what am I going to do if that goes away? How do I replace that? Non-interest expense has been better. We haven't spent as much along the way, but now we're being forced into some discussions about technology and what we need to do. We have to watch the growth in expenses relative to the growth in the yields and the costs as we move ahead. Good to see the efficiency ratio getting better, but a little bit of that was asset-based related as we look at that. But all in all, pretty steady Eddie along the way. The big question is, as I look at net interest margin since 2004, we saw about 10% decline over that time period. And actually over 15 years, that's not too bad. But I was dealing with a client just this morning in an ALCO call, and their projection is to see about a 15% decline in their margin over the next 18 months as that balance sheet they have today reprices down and refis out from under them. And my question is, have you been seeing similar declines over that 10 years? And what's your sustainability of margin looking forward? Are floors enforceable? Are customers willing to take the deals? Or are they getting picked off by other opportunities, and how do you complete? Because if I'm seeing a 345 margin after a 10% decline, that's going to have a pretty big bite out of a lower ROA. And I think one of the things that we've seen change in the last 10 years has been a movement away from spread into a lot more transaction-oriented income, which means that if we're on the transaction level, we have to replace it over and over again. It's not there over the long run for the duration of the assets and liabilities that we have. So anything you want to add to that, Rob? Any thoughts that you've got on that front?
No, I mean, Dave, when we talk, I don't want to jump ahead too far, but when we talk next week on some loan pricing, it gets to the heart of loan pricing, right? Maintaining
Right.
that net interest margin, what products can you offer that maybe help maintain that net interest margin are big deals as we go along here.
So let me pose the first polling slide then, and Jesse, if you would, thank you. We'll give you 5 minutes or so here, but we'll probably cut it off early because I don't need you to. This is a yes or no question. Should be pretty quick. Do those trends that we just showed, does that kind of feel like the way your bank's been operating or your credit union's been operating over the last decade? Do we see a pressure on margin and kind of a managed growth position trying to preserve capital? Is that kind of where you've been? So we typically give you a couple of minutes here. The default is 5, but we could only say, Jesse, when we get a good enough level of answers, we can shut her down and share the results. As we're waiting, don't forget, this is one of those CPE credit slides, so don't forget to jump in there and make sure you do it. And if you're having any trouble at all with answering the poll, just dump your answer into the Q&A box. That'll be fine. How we doing on the response rate, Jesse? We got doing pretty well. Oh, you're on mute. Sorry.
Yeah, no, it's all right. Yeah, I think we're where we need to be. Hold on.
Okay.
A few more.
Give you a couple more seconds here, folks. Minute and a half is usually good enough to get an answer in.
Okay, I'm going to go ahead and close the poll.
Great. So let's see what we got here. What do the answers look like when we share that up?
And it's give me about 5 more seconds. It's processing.
Yes, the technology sometimes needs a minute to catch up with what we're thinking. Okay, good. So we got a few of you that we didn't get an answer from, but I know we've got some staff of the Home Loan Bank and other people on too. By and large, that's pretty much what we're dealing with. For those of you that aren't interested to know how it's different, what kind of things have you done? Maybe it's going to fit very well into what we're going to talk about. But good, that's a good start. Let me take you to a little bit more recent set of information then, and talk a little bit about the Q1 FDIC results. I'm really interested for when Q2 comes out. They're not out yet, published that I've been able to find. But what are the things that we saw? And this breaks down the net interest margin performance from 08 through 20 by asset size. And I found it really interesting because if you look at the graphs on the community bank or the bank as a total asset size ranges, you notice that it's a pretty clustered group unless you're really big. If you're really big, you're playing on a much lower margin, but everybody else is running in that 3.5% margin. And when you look kind of to that 16 to 18 period that we talked about, we saw that rise in the margin happen when rising rates happened, but that rise in rates was less than a half a point on the margin. I mean, that's not what we would expect. We would expect for 300 basis point move, a little faster move than that, a little bit more aggressive move than that. And then as rates turned back around and came down, we all saw sort of a jump down here as well. Some of us a little bit higher depending on size, but we're seeing declines in the margin levels. And one of the things that's causing that is the declines on the yield on assets are dropping at a faster rate than the cost of funds, but for most of us, the cost of funds stayed up. And I think that's one of the things that we're wanting to keep an eye on, because the cost of funds made about a 25% change in their rates as rates rose. They came up 25%, but the yields didn't. So we didn't get as much of a yield increase, and we certainly saw a faster decline down on the yield side relative to the funding cost side. And from a sustainability standpoint, that makes us a little bit nervous along the way. Non-interest income. Sharp decline in Q1 of non-interest income in the smaller banks, probably due to the asset growth, because this is being reported as a percentage of average assets. And so you probably had a constant dollar amount, but assets as a whole rose in that first quarter. I'm expecting Q2 and Q3 levels to be better, but I think also we might see some of that depression when we look at this number, because assets are up significantly across the board as well. My big question on sustainability for you all on the non-interest income side is, what are you going to do next year to replace PPP income? What are you going to do next year to replace the mortgage origination income from refi? I've got some clients that have said, we're taking all that income from PPP or mortgage origination, we're dumping it into the provision expense. That's how we're going to fund getting ready for future loan losses in CECL. Okay, that's fine. I got a problem with that. That's a good example of having a plan for it. But let's make sure they're sticking it through now so it doesn't get their earnings levels up and confuse people, I guess. Equity, not a problem. Look, gang, we have plenty of capital. We are well positioned again to withstand this. Tier 1 equity, equity capital, Tier 1 risk-based capital. We're all in pretty good shape along the way to manage through a downturn. But you can see it's tipping down a little bit. Again, denominator-based total assets going up, primarily the big cause here. But if you think about it, the lower levels, when a big bank has an opportunity to carry significantly lower capital than we carry, it gives them somewhere about a 2 to 3 times leverage by growing their banks and continuing to offer products by letting capital trend down a little bit. And so I think from a capital planning standpoint, it's really incumbent on us to all to say, how much capital do we need to be available in the event of a really bad condition after this downturn, after this pandemic? And how much of that could we put to work now so that we continue to generate the earnings necessary to feed capital in the future and to continue to grow? It's a question each of you has to answer depending on your business model and sort of your operating environment. But clearly, larger banks are holding less capital than smaller banks, and it puts it at a little bit of a competitive disadvantage for growth because I have to earn a whole lot more to stay at a 12 or a 10% capital ratio or a 14% capital ratio than I do when I'm at an 8% capital ratio. Something to think about. And if you look at the last piece here, and Rob, this one kind of gets to your specialty, we saw a huge increase in the loan loss provisions here, right? As a percentage of net operating revenue. Look at that increase in the net operating revenue being spent in provision, and look back to the beginning of that graph, pre 2009 bubble. And that's sort of the same kind of tenor and move that we saw back then. And it was all the bigger banks that really started to do that. Any comments you want to add to that?
Yeah, I mean, this is actually a pretty interesting slide. And once again, it might not all be related to CECL, but a lot of the lines that you're seeing going up are probably by publicly traded banks that were a little bigger that maybe implemented CECL in 2020. And we'll get into a slide in a minute that the whole point of CECL was to incent banks to provision before the losses occurred. And you'll see the two lines at the bottom, the assets from $1 billion and less than 100 million are pretty flat still. And I think that's because they just haven't, one is they don't know what the losses are going to be from COVID-19 yet, right? And so because it's an incurred loss model, it'll be delayed a little on that side. But it is very interesting graphic there for the first quarter based on whatever people thought was happening with the pandemic, for sure.
Yeah, I mean, it certainly got another shoe to drop for some of us here. Nice to see the 1 billion to 10 billion had some move up, but my 100 million to a billion and less than 100 million, that number is likely to rise, and we just don't know when. And so be thinking about that. That might be where that PPP income makes sense that you're putting it in there. It's coming in as revenue, but it's going right back out the door as funding. Seems like a good way to cushion that if you can afford to do that.
Yep.
So let's talk a little bit about future loan losses, Rob. Tell me a little bit about what you see in the crystal ball coming, and what do we need to be thinking about as we think about sustainability from a future loss perspective?
Yeah, I mean, this is it's an interesting time we live in right now, right? The government did a lot of program with the CARES Act to help get money in people's pockets to help businesses out. The good news is they flooded the market with money. The bad news is they probably delayed some of the impact of COVID-19 and some of the losses you might incur till later on down the road, right? So just the way with, there was skip-a-pay programs and forbearance programs and all that fun stuff. It'll be interesting to see when those losses actually occur. So you can kind of see the whole point of CECL on the slide Dave has up right now was we were trying to get to the blue line, which kind of represents what some of the bigger institutions maybe did in Q1. And you'll see that the red line is kind of what the incurred model did. And so when we ran into the crisis in 2008, most of the increase in provision expense happened after the financial crisis, right on the tail end of it versus the beginning of it. And I'm guessing we'll meet somewhere in the middle when CECL finally gets rolled out. But you'll see that those peaks are still about the same height, right? And that's the risk we have is I think we all can agree that our loan portfolios probably have a little higher credit risk in them than they did in February of this year. The other important thing to remember is segmentation of your loan portfolio. Not all industries are going to be impacted the same way. So if you had a lot of hotel motels or restaurant and lodging, you're probably going to be more impacted than if you had some other types of industries. And so understanding your industry concentrations will be key as you understand those losses. And then, Dave, if you flip to the next slide, I think we can talk a little about understanding what is your boundaries for your losses that you could sustain, right? So if things get pretty ugly, I really like a reverse stress test, which is how much money could you lose in loan losses before it impacts your capital ratios and drops you below where you perceive yourself as well capitalized, right? So you might have a higher target than regulatory minimums on your capital where you want to be. And what is that number that you can lose and still be above that number? And is there an event like this pandemic that can drop you below that where you're worried about your capital position? And so I think there will be some definite impacts from COVID-19 on your loan losses, depending on your size, and depending on how the government continues to flow funds in to help businesses will, I think, determine whether you see them later this year or sometime next year for sure. So
but are you thinking that that losses, the level of losses is somewhat already known? I mean, it's not known, but that government assistance is not necessarily going to save a lot of. If it's a bad loan, it's a bad loan, I guess is what I'm saying.
yeah,
It'll save a few, but it's still going to. There's still going to be a certain amount of them that just no matter what you give them, it's not going to probably change it.
yeah, and I think the sad thing, like I said, and I'm kind of from the Midwest, kind of a small town kid here, is a lot of the smaller family-owned restaurants that have been around for 40 years. They're the ones that probably didn't make it, and so you're not seeing that yet. But there's a lot of smaller restaurants that just didn't survive, right? That maybe
Right.
you haven't realized yet. Maybe they got PPP loans and they're still trying to figure out if they can make it. But there's going to be some impacted industries and businesses. And you're right, Dave. If you're teetering on the edge, this is probably going to push you off the cliff regardless. If the government tried to
Right.
save you or not, you just might not know you're off the cliff yet. So
Yeah. I mean, it's a helping hand for a while, but unless we get some serious recovery, get people back out and truly allow things to get back to more like they were. There are some that just, I mean, we have a longtime restaurant here in a little Swiss village south of town. They just didn't reopen. They're not going to. They don't need the money. They did it because they liked it, and they said we're not reopening, and the business is for sale now. Now who's going to buy
well,
that business when they can't open?
yeah, Dave, and when we talk about how these loan losses occur, it's a new model, right? So the cash flow for a lot of these industries have changed. So if you only can seat 50% of what you used to see, now
Right.
you're working with a different model as well, trying to figure out how to make ends meet. And I know they're working with a lot of financial institutions out there trying to figure out, yeah, can I survive this? When will I get, you know, more cash flow capacity back, and all that? And can we survive this, whether it's 1 year or 2 year experience with COVID-19, to get back to what seems like a new normal, I guess is what you would call it, Dave. So
Yeah, and it makes me concerned from a liquidity standpoint because we've got all this money that's sitting there. What do we do with it? We're not making a lot of money on it right now if we're not lending it. And if that business fails, I don't know what the requirements are if they don't reopen. I mean, I haven't read the PPP guidance that far, but if they blanket give away the store and say everybody's forgiven, then I guess that money stays, becomes cash for the business owners. I don't
yeah,
know.
it'll be interesting. Yeah, because it's guaranteed, right? So hopefully,
Yeah.
us as financial institutions won't be left holding the bag, but the SBA government will be. So yeah, it'll be
Right.
interesting
Yeah. So
over the next several months.
we're holding on to that as the bank, right? Or the credit. We got the money sitting in our accounts. We're trying to figure out what to do with it. It could go away because they spend it, or it could stay. And I don't know how it's going to stay, but how long it's going to stay, what it's going to be. It's a very uncertain time as we talk about a liquidity position. So how do you measure liquidity right now? I mean, is loan to deposit ratio a good idea when the government floods us with $2 trillion worth of excess funding and suddenly deposits in the banking sector are up? Do we look like we have any less risk today if those deposits aren't necessarily deposits that we believe are going to stay? I have a very, very hard time figuring out how to measure the right liquidity ratio for people when I don't necessarily understand that big influx that many of us are sitting on. So we have to be careful about that. We have to look at the definition, and we have to get away from some of the historical measures, and we got to be able to look at two different ways. I look at two different measures: operational and contingent liquidity. And obviously we're here with the home loan bank, and I would say most of us would think the home loan bank is a great source of contingent liquidity. I'm going to argue that over time, it's probably going to become a pretty big base of operational liquidity too. I think we're going to need some of those programs in order to build the asset structures that we want to be sustainable. More on that to come. But there's not a lot of places you can go get that structure. And So when we look at this, operational liquidity is sort of the asset side of the balance sheet. What do I have? What can I convert to cash? The stuff that we know about, right? We got to be able to measure that. Might call that core liquidity. But then we've got to have this cash flow based liquidity. And that's where we got to understand what's happening to meet the obligations. There's stuff going in and out. We're making loan demands. We got other commitments. And most of us have been getting better at doing that since 2011 when all these things came out. So I think we're doing a pretty good job there. And then that contingent liquidity is the stuff that we could sell, the things that we could borrow, all my non-core funding sources. And we've put some guidance around limits internally on that. I just want to think about it like this so that we could all be able to talk about this simply. Liquidity makes you think of liquid. Liquid makes me think of water. Water is a huge source of sustainability for everyone on this planet. We have several ways in which we store water to make sure that we have access to it. We dam up lakes, we create retention ponds, right? And we hold that water. That's like our asset-based liquidity. What have we put available to us as a stock of assets that we can convert very quickly? And we try not to have too much of that, because when we have too much of that, those things don't typically earn us a lot. We would depend a whole lot more on the flows, right? I mean, if you think about where most of our liquidity comes from, it comes from the standpoint of we have flows of loan repayments and maturities and investment repayments, deposit inflows. Those are the things that sustain us month to month, quarter to quarter. And when we just get done talking about we don't know what the losses look like, my liquidity, like we saw last time in 2009, 10, 11, my liquidity could be threatened because I'm going to have no longer will I be able to get loan repayments coming back in as I expected, which means I'm going to have to draw down on my cash and my high quality asset levels, right, in order to meet the demands, or I'm going to have to pull back my availability to meet needs, or I'm going to lean on my bottled water, on my contingent sources. And so we have to understand how we use each one of these. And I think from a sustainability standpoint, we need to be able to weave contingent sources like borrowing lines into a portion of that being a stock of funds that's off balance sheet that we can use, right? We can sell an asset or we can buy a borrowing. Both of them carry a cost. Which one makes more sense? So we need to start getting a plan together that says, here's how much of my borrowing capacity I'm going to use to manage my business today when it's really hard to predict some of the flows that we're going to see on deposits, what's going in and what's going out. Something to think about along the way. What are some of the things on the pandemic slowdown, the economic slowdown that might be coming from the pandemic? The deposits that we've been talking about, the loan repayments, the credit risk that we've been talking about. How long are we going to be able to keep the deferrals and forbearance? I mean, it's supposedly coming to an end, the grace period, just waiting for that can to get kicked a little further down the road. Somebody's going to say, let's give them a little more time. We haven't seen draws on lines of credit because people got enough cash coming in. But I still remember the day that Boeing announced that they were going to draw down their $6 trillion or whatever it was line of credit from their bank. I would have hated to have seen that and not had a call from the CFO of Boeing saying we're going to take our money down. But, you guys have lines of credit out there, and there is a risk to our potential needs that we got to be very careful about trimming up and managing those contingent lines so that we can meet the obligations and make sure that people are credit worthy under the current situation. Under those line of credit agreements that we've made. So we need to really test some volatility there. What happens if we are wrong on some of these key pieces, and make sure that we're able to meet the demands so that we still have the contingent, I don't know what I need, but I've got a place to go get it, Home Loan Bank and others, versus I'm going to use some of those programs to manage the ability to grow today and grow strategically and profitably in areas where good credits live and exist. So something to think about. So what's the most important funding source of all? When I saw those of you that were at the annual meeting out at the golf course, I said the biggest risk we worry about isn't interest rate risk movements, liquidity risk, and the ideal funding source really is more about how do we continue to grow customer deposits along the way, whether they're retail or commercial. I don't really care. It's your business, however you go get them. But the deposit is really where we'd like to have it. And we know that we'd like to have things in more transactional checking type relationships where it's not so much about rate that we pay, but more about features and access. But as we go out that continuum, we move from more rate to more, from more features to more rate type pieces where loyalty begins to change. It's a lot easier to build deposits at a lower rate environment when you don't have to pay for them. The question is, who do you have to pay for when rates go up? We don't know, and we don't worry about it because we think we got 2 years before we need to do that. But I think funding sources are ultimately awfully important. So let's just ask this question. What drives consumers to buy checking accounts? Right now, it's been known that about 6 to 12% of consumer checking accounts turn over every year. So if I know that that's true and I'm a consumer checking account business buyer, I know that I've got to replace a certain amount of balances. So I need to know how many accounts I need to get per month, per branch, per, per location, per market area, whatever you want to know. What's causing people to buy that? So let me ask polling question number 2. Which of these things would you say are the most important reasons? I know they're all important, but which one's the most important reason on why a consumer chooses a checking account? Is it features, location, convenience, fees, brand recognition, or friendliness? Give you another, let's give them about another 45 seconds, Jesse, to answer up.
Okay.
Again, pick what you believe. What's most important to you if you don't know? What would make you choose a checking account? I'm sure you're doing all your checking account business with your financial institution, so you wouldn't want to leave there because it might jeopardize your job. Just kidding. But what's the most important feature?
I'm just processing the answers right now.
Great. I'm going to bet location. Ooh, convenience. Convenience beat location hands down. Look at that.
Wow.
Convenience was the hands down winner. Fees were not nearly as big as they've been in the past. That's interesting, right? If you would have asked that same question maybe 5 years ago, fees were a much bigger component to checking account relationships than they are today. Convenience, product features, accessibility online. Some of those things were other options that we could have answered. And we know that all of these things play together. So thank you for that answer. I think the thing that's interesting, and the reason we ask it is to lead into this piece, and that is in 2019, J.D. Power ran a retail banking satisfaction study across the U.S., interviewed a ton of people. And they basically said that only 4% of the consumers shifted their primary accounts to a new institution. I got done just a second ago saying 6 to 12%. That's been the long run historical average, but it's been slowing down. The largest banks, the top 10 banks, increased their overall share of deposits from 39 to 48% since 2009 when they started measuring this stuff. That's a huge increase in market share of deposits. And I worry about sustainability because we can't sell money we don't buy. So we're not buying, we just lost 9% market share to the top 10 banks. Why are they moving? Because it's so convenient. What did you just tell me? Convenience matters. The big 6 banks have gotten better satisfaction scores from the under 40-year-olds in 2019, and they attain a higher score than regional and mid-sized banks. In other words, younger people like the top 6 banks. Why? Where is it? Because it's easy. They have the tools. Everybody said digital-centric customers are what we want. And over on the right, the thing that was very, very telling to me is customer satisfaction and convenience have gone up across the board, but too many customers haven't built trust back yet. They're still concerned about some of the tenure. Now, I would bet there's an age bias to some of that based on some of the other data. But in 10 years from now, when digital banking will now be the norm. So this is 2019, pre-pandemic. I think we jump-started this discussion this year. Digital banking took a huge step forward for nearly every single customer, regardless of how they bank with you. You're going to have to be unique by one of two things: scale or strategy. Size or strategy is going to become how you differentiate yourself. So you got to decide, are you going to be able to scale up your bank? And if you are, how are you going to maintain 12, 15% capital? Or what's your strategy going to be to maintain 12 to 15% capital and still be relevant in growing future depositors today? Find that message. That's the sustainability trap that I think we're in. We're doing pretty well and it feels pretty good, but you start looking at things like Chime and American Express Bank, or you look at Marcus, you name it. There's all kinds of online competitors out there that are competing. Don't forget the big bank killer of Google that we were talking about before. There's a lot of competition coming. And what you got to do is decide, how am I going to play it? Like American Express Bank had some pretty good rates back in the middle of April. They're down now like everybody else's are, but it still felt like you were banking in an old money type bank as opposed to Chime, which is a checking. It's not even, they don't even call it a checking account. They call it a transaction account. And you just run debit card transactions through this as an app. So interesting different plays there. And why is it that the old world banks started building out online presences with different names so that they could market differently to different demographics? So I think that's a pretty important discussion point for us as we go forward. The good news here is that we're saving more because we're not going out and spending, but before that, savings rates were up. So you've got liquidity that's still out there. And I think there's a renewed interest post-COVID with the PPP lending opportunities that you all took advantage of and did a great job of executing on, to sell the idea of Main Street and to sell the idea of we're in your backyard. So I think we have, with economic uncertainty, an opportunity to grab some of those balances. But what are you going to do that? And how are you going to roll that into a long-term relationships, right? Even though we have opportunities to open up electronic banking, there was a survey of electronic banking trends in 2018 that said most people prefer still an in-person account opening. I think that's be careful on that one. I don't have all the data behind that quote, but it's a quote that's real. It's stats that are real. I just don't understand. I think that's going to draw very much along generational lines. I mean, I think that's just e-sign, and funding online seems to me to be a much more realistic way to be thinking about stuff. Large bank market share growth is not universal. They're not growing everywhere, and all banks are not growing. Some are having a harder time than others. And we've got all these fintechs looking to partner with banking somehow. So you see that whole aggregator methodology to try and bring some of these folks to market, where you don't have the technology or can't afford to build it yourself or buy it yourself. We're going to see more and more partnerships along the way. So I think that's a quick look at liquidity and sustainability from a deposit perspective. Let's talk real quickly about managing future sustainability again then, and what the future holds. It's our belief, and I think the Fed's been pretty clear in saying lower rates for longer are here, right? I mean, we're expected to see Fed hold action until we see 5% unemployment. Most economists will tell you that's probably 2022, 2023 before we get there. So we're going to be looking at a very low, flat curve for that period of time. I don't know about negative rates. People have been worried about it. We've heard pretty distinctly that this Fed doesn't have any interest in using negative rates. They'd rather buy corporate bonds and other things to manage their balance sheet and blow that up instead. So I'm not too worried about negative rates, but maybe you got to worry about it. I think your biggest compression on margin now isn't really about rising rates. It's about sustained low flat rates. I think that's where we get hurt, because we can't make loans higher on the spread out at 5 to 10 years and buy money short. That's a problem. And we've got some issues here in terms of non-interest income, raising our non-recurring earnings that then start to go away. So pick your planning horizon. 2 to 3 years is probably about all you can do effectively right now, somewhere between tactical and strategic. You need a good tactical plan for 2 years, and probably some idea on 3 to 5 on what you're doing for the future. So let me set up a scenario for you that we're going to use as we go through the rest of this session. This is our sample bank as of 2019, pre-COVID. Just made a $750 million bank. You can see loan to asset ratio, 600 million. 80% loan to asset, 90% loan to deposit. ROA is running around 75 basis points, been coming down. Good tangible capital ratio, 10%. If we look at some of the mix of the loans, we do a little bit of everything all to the end. I made it a little bit easier for us to see. 35% in commercial real estate. We do some 1 to 4 family. We do some construct. We got some other, and you can see the yields at our current offering rates. I mean, we've been yielding pretty well, but now we're down to about 391 average on our offer rate. It's not weighted particularly well for originations, but you can see rates at the beginning of the year were 375 to 4 on a lot of these products. And if I don't make loans, I'm buying securities back then at about $1.25, which is now down to what? And they're now down to pretty close to zero at cash. So I've got some risk if I stay too deep into cash. And all the loan rates that we're offering today are lower than rates that were in portfolio. So we're seeing prepayment potential on the portfolio. Pretty normal mix of deposits, a lot of non-maturity deposits, more weighted in money markets and savings. Pretty good now. Some DDAs are up. A lot of us see DDA growth. Been using the Federal Home Loan Bank for overnight. We've upped the game in brokered CDs a little bit in the last year because it was a little cheaper than trying to buy it from depositors because there was cannibalization costs. Expensive overall, but relatively speaking, it was a short-term, inexpensive move. It just kind of looks expensive at its average cost basis. If I take that to an income statement and I say, what's this going to produce for me for earnings over the next year? Expect my margin to come in the next year about 314, non-interest margin about 2%, put some provision in there. Looking at about 62 basis point ROA after taxes. Not particularly, exciting, but that's kind of what this projected earnings of this institution is going to look like. If I run it through a rates up and a rates down scenario, and I'm going to use more realistic rates up and down than the 300 basis point immediate shock because I don't believe that's going to tell me much. When rates go up, I'm going to make some more money over the course of the year. If we get some rates to go up, I should make another 40 basis points or so. If rates go down from where they were at December, I had a little bit of downside risk. I'm going to lose about 6 basis points worth of earnings. So some fluctuation was built in. The question really was at the beginning of the year, what was the projection for rates up versus rates down? How many people saw rates going up this year? So that's our picture of our bet. What rates do you fear today? Like as you sit around your board, ask the question, are you sitting there saying, I'm ultimately concerned about interest rates going up? I don't have a lot of people that answer yes to that in the next 2 years. So what do I need to do to be sustainable and manage my earnings over the next 2 years? If it's rates same or rates down, here's something I want you to think about. If you can make a lot more money when rates go up, is there not an argument that could be made that would say rates staying the same, we're not making as much as we could? Wouldn't there be some things I could do today to increase earnings today at the expense of possibly making more money tomorrow if rates go up? That's the question that we want to find. So we have some concerns. We'd like to get some more income into the balance sheet or into the income statement. We don't like that decline in margin. We've got cash that's not earning us stuff. We want to grow a little bit more. We've got capital. So I mentioned to you that some of the data shows that we could grow. Can we grow our way out of this? So what we did with this one is just simply said, let's put $75 million on at 290 average yield on long-term assets. Customers were asking for longer terms than what we were offering. Let's say we met them at 290. And let's fund it at a 40 basis point cost. So my margin on the growth is 2.5%. Well, why would I add 2.5% margin when I was earning more than that on my margin today? Well, because that's what the margin is that's available today. But if I can generate that extra $75 million in assets, but it doesn't cost me any expense on the non-interest side to do that, well then by adding $75 million, while my margin would go down from 314 to 308, the non-interest expense holding at the same dollar levels drops to 273. So I'm using the plant that I have as a financial institution to use it to fund more assets, and that's why we have capital, so that we can take a slightly larger position that way in order to make a little bit more money today. Now, look, I'll argue with you too. That's not a lot. 8 basis points doesn't seem like a heck of a lot of a win there. But what happens if we ended up seeing rates go down? Well, after growing, if rates went down, I'd be back to the same level I was going to be for earnings as if rates were the same. I'm just $75 million bigger. I'm producing more total dollars of income. My ROA would go up. But if rates were to go up, I would lose. Instead of making more money, now I would lose some money. Welcome to asset liability management, folks, right? This is what we need to be doing here. It's having this discussion. Why would I not give up? Well, if you really believe rates are going to go up in the near term, you may not be willing to make this bet. But if you think rates are going to stay the same or rates are going to go down, maybe you want to take a look at this as a strategy. Maybe you don't. Maybe that's not enough income to make up the difference. But are we looking at it? Are we having those discussions? Are we saying, can we meet some of those crazy demands that are in the marketplace and take some of the possible earnings that we have when rates go up? We all fear interest rate risk at the bottom of the rate cycle, but you only get to spend that money that you make when rates go up. You can't spend that now. I need to produce income now to pay the bills. So do we have enough exposure or do we have too little exposure to some interest rate risk? Is a question that we need to think about. I'm not sold this is the best strategy yet, but I want to get us thinking there. And I want us to get us thinking by what is our goal. So for the next 1 to 2 years, in your institution, what is your goal? Here's what we were working off of. I want the net interest income or the net income, and if rates stay where they are, go down, flatten out even further, to stay where I expected them to be. I don't want to see downside pressure. I want to raise the bar up there. I'd like to keep capital above the regulatory well capital ratio to 2%, as we talked about a little bit ago, whatever that number is for you. I want to make sure I keep my long-term excellent credit clients. Don't let them get picked away by somebody else. And I'm willing to trade tomorrow's possible earnings for earnings today. So when I went long-term, my big concern was if rates go up, I might lose. If I asked you to think about a long-term rate position, would that long-term rate position that we were taking be a concern of yours about the yield on the asset, or would it really be more of a liability problem? Are you more concerned about the liability costs going up? Most of the time we worry about that because we're not sure that we can maintain the cost of funds. If we could lock in the yield, we might be a little easier to deal with that. That's a funding problem, not a yield problem, although there's some things we might be able to do to deal with the yield on the asset side too, and we'll look at that in session 2. But we got to measure all the measures out there: capital, margin, all of the ROEs, dividend rates, all those things that matter to us need to be measured. I'm taking a very short look at it here. But if I take a look at those money market rates and I say, look, there's that slide again that shows the mix. If I wanted to use wholesale money to help fix that. My concern is that I've got a bunch of money market money that I'm, paying a high rate on now, or I was in December. If rates went up, I might have to pay more for that. Is there a way that I could avoid paying more for that by using some of the wholesale sources? Right? What's my bottled water of need for liquidity sources for my wholesale sources? And what's available to me today to actually manage my balance sheet? I think we need to look at the volume and the marginal cost of the retail solutions. We don't have that problem when we look at the wholesale solutions. Whatever I'm paying is what I'm paying. So I get nervous. I've heard from home loan banks, and I've been working with several of them over the last months, and they're reporting back that they hear from their members, we like to keep our Federal Home Loan Bank powder dry. And that's an interesting term, right? Dry powder's there when times get a little crazy, get a little wet, and you need ammo. You got to be able to shoot it. When is that time? If now is not that time, when interest rates are at zero almost across the board, and there's uncertainty in the market, when is dry powder okay to use? I'm not saying use all of it, but when's it okay to use some of it? We see brokered CDs being used, but they don't have some of the structures that we could use in the home loan bank to manage our institution more appropriately, because we tend to keep those a little bit shorter term. Think about wholesale strategy analysis. We'll take a look at some of those ideas some more. But what really gets me a little bit nervous here is the segmentation idea. We've talked about segmentation with you guys for years. Tom Farron for years when we'd come out and talk to you, me, whatever. We try and pay up for the balances that we need to grow without paying up for the old balances, right? In today's world, it's a little bit different. How far can we drop rates without losing money? That's probably a different way of thinking about it that we might want to consider. So how long do you wait? What's it look like? Let me just ask this question right here. Looks like I had a slide disappear. Might have moved on me. Oh, no, there it is. I went past it. Before I open the polling slide, Jesse, we'll finish with the polling slide and then wrap up. Here's an example of a marginal cost example, but I'm going to turn it around. I'm going to say, let's make strategy 2. Forget what this says. Strategy 2 is this is what I'm paying today to hold on to my money and nobody's going anywhere. Okay? I can't get money to leave if everybody's there. These are my new rates. These are my new rates. These are my balances that I'm holding on to, my expense. What if instead of paying up for 2.5% CD money, I just drop that and I let some of that money walk out the door? Instead of trying to hold on to it all with some special, what if I let it walk out the door? Well, then what would happen up at the top is I'd lose about $1.6 million in balances, the difference in strategy 1 to strategy 2. But I'd save about $55,000 worth of interest expense by not offering that higher rate. In other words, I could go out and I could buy any kind of funding that I want for less than $345, $1.6 million worth of funding for less than $345, I'd be money ahead. I'm pretty sure the Topeka Home Loan Bank rate for 12 months is less than $345. So should I save $55,000 worth of expense, net the difference of the expense for the borrowing? Is that a sustainability move? Is that a lot? No, but little nickels add up, right? We need to be careful that we don't spend too much. We have dry powder for a reason. Now's the time. Think about segmentation and just answer this question as we wrap up today. Do you have a funding plan that's more than just a deposit growth and average cost of funds? Do you do something differently to project your balances and rates for future funding? I believe, folks, that funding is one of the most important challenges that we have going forward. So as we look at that challenge going forward, we have to maybe meet it with a different set of tools than what we've used in the past, because we're in different times than we were in the past. A couple more seconds for you to give an answer to how you are using funding plans. And we could start moving that to even 2021. That's going to be a lot harder in 21 because we got to figure out what's going to stay from COVID. I had one customer that had about a 20% increase in DDA balances. Pretty highly linked to their PPP lending. Is that money going to stay? What do we do with that? All right, Jesse, what do we got? If you're speaking, you're on hold or on mute, but that's okay. I'm guessing you are crunching the numbers, waiting for it to pop up. Across the board, a little bit of this. We didn't give as many answers there, but that's okay. Everybody's got, to me, we spend a lot of time projecting loans. We spend a lot of time thinking about how we're going to grow the balance sheet on that side, but we don't necessarily have, the good news here is more people have, an internal rate of return approach than I would have guessed, but it's kind of a smattering across the board. Everybody's using a simple budget. I think we need to be really careful going forward about putting some resource allocation and understanding about those deposits. In some other seminars that we've done and some of the data that we've seen, we've started to notice that the age of the depositors is getting to be older and older, and the replacement of those major dollars of funding becomes more crucial that we understand now before they start to leave. So give some thought to how we might think about that differently. And let's talk a little bit about wrapping up then from a balance sheet management perspective in today's session. What we're going to do next time is come back and actually put some ideas in front of you, talk a little bit about how to select assets in this world today. Where do I go to decide if something's okay? And then take a peek at how those would go together and actually add overall, can we compete on some of these things that maybe we don't think we can? How do we use those tools? But today, I think the first thing that we talked about is what are your goals for sustainability? I clearly outlined the goals that we had. We wanted to raise current earnings and protect them in the potential of longer term lower rates. That was our goal, and we'll do that at the expense of capital and future earnings if rates go up. That requires us to do a better job of modeling, including our business plan, having a better handle on future what if type capabilities. So I think there's a lot of pressure on us in the management of the balance sheet today from all kinds of markets, competitions, and scale. How are we planning to position ourselves? What's our response to that JD Power piece? How are we going to take strategy to beat them, or are we going to try and compete on scale? And if it's strategy, clearly outline and align everything to that strategy so everybody understands that. Make that mission very well known in your market. And then realize that the things that we've done in the past, as an industry of community banking, we have mainly looked at interest rate risk with an evil eye. I don't think most people in this call are fans of interest rate risk. But look, right now that might be the only way we can go out and generate additional earnings. I don't think we want to take credit risk on in the face of the storm. And we got so much liquidity right now, liquidity risk may be drowning us. So there are ways to manage all of those risks, and we have to decide which ways we're willing to take on to some level. Not saying bet the farm there, not saying everything we do, but does a little bit of that help fix some of our potential goals without overexposing the institution over the long run? We need to take off the blinders of what we believe, and we need to look at it and say, does that make sense in today's market, and to remain competitive? So think about what your priorities are in the next 3 to 5 years. What are your economic conditions that you think are going to happen? Mine is that we're going to see, 2 years out, we'll start to see the short end move up a little bit. We'll probably get back to an inverted curve for some period of time before long-term bond rates go up. We got a big Fed balance sheet out there that long-term bond rates will make it very hard again for them to sell those assets when they want to get out. So given that, here's the goals. So set up your priorities and make it along the way. Something that everybody on your board, your management team can buy into. So let me stop there for today and say we'll come back next week and we'll pick up that little balance sheet that we were talking about, and we'll use that as a basis. In the meantime, if you've got any particular thoughts, questions, or ideas that you'd like us to add in, our email addresses are on the bottom, or you can email advisory@abrigo.com. Happy to take those and try and fit those in along the way. I think we had one question or two questions in the queue. Is that right, Jesse?
Yeah, I'm seeing a couple of questions. Got one in the Q&A and one in the chat, I believe.
I can't see them, so.
I know. Let me go to the Q&A one. It says, a consideration for consumer choices is to move from big banks to community banks who are able to really serve their customers. Also, the FDIC's focus on innovation programs are geared to allowing community banks to be more competitive.
Right. Absolutely. And I say the time is there now. 2 years ago, we've been talking about the same thing, but it was a lot more difficult. This is an opportunity, both from the pandemic's, opportunity being presented to us, as well as some of the changes from that approach towards technology being taken by the regulator. So good point. Anything else? Sounds like we're losing. Oh,
there's one in the chat. In the chat, it says, if I understand Rob's comment correctly, CECL would have helped with COVID as we have ramped up ahead of time. unless there were some losses increasing ahead of the COVID difficulties, CECL wouldn't have helped.
Correct. And so when we saw that graph earlier, Dave, when I showed that the whole purpose of CECL was to build provisions ahead of when you actually recognize the losses. Yeah, the institutions that would have implemented CECL, now it got kicked down the road a few years, right? So a lot of institutions aren't required to implement CECL until first quarter 2023. So the ones that have look like they have bumped up their reserves quicker than the ones that have not implemented CECL. And because they're still using the incurred model, your loss history wouldn't accelerate your provision until you have those, which have been delayed by some of the government programs that have been put in place to help businesses and
which is
consumers.
pushing those losses out a ways.
Yep. So we've really delayed some of those losses in the incurred model purposely, right, to help businesses and consumers.
So we'll see. I mean, the data is still, that was Q1, was first filing. You know, we'll have another quarter's worth of filings here to see how provisions have moved and what's been happening to loan balances along the way. So, you know, our general thought is from the folks in our company at Abrigo that do a lot of ALLL, and we have a lot of CECL filers, is CECL was not necessarily going to be the only impact of that increase. There were losses that actually happened in there. You know, that provision expense, some had kicked it down the road as well, and there was some delay provisions on their part that they were given an opportunity. And I think some people parked some earnings in there against future losses. So we won't really know if that was all CECL related or not for some time. We may never know. All right. Well, look, anything else in the question queue? Otherwise, if not, thanks for hanging on with us for a couple extra minutes, about 4 minutes long today. We will plan to see everybody back here next week on session 2. Once again, the resource page is out there. The slides are posted. You can take a look at the material for next week. I think they're out there already. And if you have anything directly that you want to get to either Rob or myself, there's our email addresses. Feel free to reach out. Just be sure to let us know that it was from the Topeka session, and we'll get back with you. But until then, have a great rest of the week. Anything you want to wrap up with, Susan?
Yeah, if you guys are wanting CPEs, if you will email your regional account manager, let them know. They can forward that to me, and we can send them a certificate to you.
Perfect. All right, then. Appreciate your time today. Thanks, everybody. Stay well, stay safe. We'll see you back here next week.
Thanks, Dave. Thanks, Rob.
Take care, folks.
Thanks.